Aaron thought he had it all figured out when he bought his first house. He'd done the research, he ran the numbers, his mortgage payment came out lower than rent, he put 20% down, locked in a solid rate, and stopped paying a landlord for good. He thought he'd solved it. He didn't. The house he's so proud of is quietly the worst performing asset he owns. And that $80,000 down payment, the part he's proudest of, he could have grown it himself, somewhere it actually compounds, and kept every dollar of the return. But here's the part that really stings. His coworker Scott bought the same year. Except Scott always said renting was throwing money away, so he bought the biggest house the bank would approve. Scott pays about $3,800 a month. He thinks every dollar is going towards something he owns. It isn't. Roughly $3,400 of it, interest, taxes, insurance, upkeep, is gone the moment he pays it, the same way rent is gone. He builds barely $400 in equity. He walked away from a $2,000 rent to set $3,400 on fire every month. And he calls it an investment. Scott thought renting was the trap. Aaron thought he'd outsmarted it. They were both wrong, just at different levels. Professor Wealth ran the numbers on both. Here's what nobody shows you before you sign. Aaron did everything by the book. This wasn't an impulse buy. He saved for years, built up a real down payment, checked his credit, and shopped 3 lenders to shave his rate. He found a $400,000 house, put $80,000 down, and financed the rest at 6.5% on a 30-year loan. Then he ran the one calculation almost every buyer runs. He compared his monthly mortgage payment to what he was paying in rent. His rent was $2,000 a month. His mortgage payment, just the loan part, came out to about $2,020. Close enough, he figured, and at least now he owns it. So he signed. And that's the trap. Not because Aaron did anything dumb, he didn't. The trap is that the mortgage versus rent comparison is the only number most buyers ever look at, and it's the wrong number. It leaves out almost everything that actually determines whether buying made you richer or poorer. Aaron walked out feeling like he'd crossed a finish line. He hadn't even seen the race. To understand what Aaron missed, you first have to understand what he was sold. Because before anyone buys a house, they've already been handed a set of beliefs, and every one of them is doing a job. There are 4 things almost everyone believes about buying a home. You've heard all of them. You probably believe at least 2 right now. 1, renting is throwing money away. 2, a house is forced savings. It makes you build wealth whether you're disciplined or not. 3, real estate always goes up. And 4, because of all that, buying a home is how ordinary people build wealth. Here's the problem. Every one of those is either flat wrong or true only under conditions nobody tells you about. And the gap between what you were told and what's actually true is exactly where your money disappears. So let's take them apart one at a time, with real numbers, not opinions. Start with where the market actually is. The national median home price sits around $420,000. The median rent is somewhere between $1,400 and $2,000 a month depending on the source. And the average 30-year fixed mortgage rate is around 6.5%. That combination matters because it flipped something. For most of the last decade, buying was often cheaper month to month than renting. That's reversed. Right now, the typical mortgage payment runs about 20% higher than the typical rent. Buying is no longer the cheap option on a monthly basis. It's the expensive one. Now the belief that real estate always goes up. Over the long run, home prices beat inflation by only about 1 to 2% a year. That's it. Not the double-digit appreciation people remember from a few hot years, 1 to 2% above inflation across decades. And right now, it's worse than that. Home prices have actually been losing to inflation for 9 straight months. In more than half of major US metro areas, prices fell year over year. The thing everyone calls a guaranteed investment is, at this moment, going backwards in real terms. Hold on to that 1 to 2% number, because the whole case for buying as an investment rests on it, and it's about to collide with something much bigger. Here's the question nobody asks at the closing table. How much of your mortgage payment do you actually keep? Let's walk through Aaron's very first payment. His loan is $320,000 at 6.5%. On that first payment of about $2,020, $1,733 goes straight to the bank as interest. $289 goes to principal, to actually owning a sliver of his house. So after his first month as a proud homeowner, Aaron owns $289 of his home. The other $1,700 is gone, exactly as gone as rent. This is what amortization does. In the early years of a mortgage, you are overwhelmingly paying interest, not buying your house. Over Aaron's first 5 years, he'll pay down about $20,000 of his loan and hand the bank over $100,000 in interest along the way. And interest is just one of 4 costs that vanish. Add property tax, which runs around 1% of the home's value a year. Add homeowner's insurance. Add maintenance, which over time also averages roughly 1% of the home's value a year. The roof, the water heater, the HVAC, the 1,000 small things a landlord used to handle. None of that builds a dollar of equity. It's all unrecoverable. There's actually a famous rule for this. It says the true yearly cost of owning, the money you never get back, is about 5% of the home's value. 1% property tax, 1% maintenance, 3% cost of capital. Multiply your home's price by 5%, divide by 12, and that's your real monthly cost of owning, separate from any equity. But here's the catch nobody updates. That rule was built when mortgages were around 3%. At today's 6.5%, the cost of capital piece roughly doubles. The 5% rule is really a 7% rule right now. The benchmark everyone still quotes is from a cheaper era, and it makes buying look far better than it currently is. Now back to that $80,000 down payment. The part Aaron is proudest of. He thinks of it as money working for him, locked into an asset that grows. But remember what we said about appreciation. Housing beats inflation by maybe 1 to 2% a year, and right now, it's negative. So Aaron's $80,000 is parked in one of the slowest growing assets he could have picked. If that same $80,000 had gone into a basic index fund earning 7% a year, the long-run average of the US stock market after inflation, it would grow to about $112,000 in 5 years. Sitting in his house, it does almost nothing in real terms. That difference, about $32,000 of growth he gave up in 5 years, is the opportunity cost of his down payment. It never shows up on any statement. There's no line item for it. That's exactly why it's the most expensive mistake in the whole transaction. It's the one cost you literally cannot see. The thing Aaron is proudest of is quietly the worst performing dollar in his entire net worth. And Aaron is the careful one. Now look at what happens when someone believes the myth a little harder. Scott's whole financial philosophy was one sentence. Renting is throwing money away. So the moment he could buy, he didn't buy carefully. He bought big. He stretched to a $475,000 house because in his head a bigger house meant more wealth. And he only put 10% down because that was all he had after stretching. That single decision, less than 20% down, triggers a cost most buyers don't even know exists: private mortgage insurance. It's an extra charge, around $200 a month for Scott, that protects the lender, not him. He pays it purely for the privilege of borrowing more than he should have. Run his numbers and it's ugly. His loan is $427,000. His payment plus taxes, insurance, and that mortgage insurance comes to about $3,800 a month. On his first payment, $2,300 evaporates as interest. He builds under $400 of equity. Over 5 years, he'll hand the bank nearly $135,000 in interest alone. And here's the irony at the center of Scott's story. He left a $2,000 rent specifically because he hated the idea of paying for nothing. Now he sets roughly $3,400 on fire every single month, more pure unrecoverable cost than his entire old rent, and because the word attached to it is mortgage instead of rent, he feels wealthy doing it. He didn't escape throwing money away. He upgraded to throwing away more of it. That's what believing the myth harder actually buys you. So why does almost everyone overbuy like Scott? Because the entire system around you is built to push you toward the biggest purchase you'll tolerate. And like the rest of this, it's mostly invisible. Start with the pre-approval. When a lender tells you what you're approved for, you hear a target. It's actually a ceiling, the absolute most they'll let you borrow. And the bigger your loan, the more interest they earn. So their incentive is to set that number high and let you anchor to it. Scott treated his ceiling as a shopping budget. Most people do. Then there's the agent. A buyer's agent is paid a percentage of the purchase price. Spend more, they earn more. It's not a conspiracy. It's just that you could probably stretch a little is never neutral advice when the person saying it gets paid more if you do. And underneath all of it runs the oldest pressure of all: buy now or be priced out forever. It's a powerful line. It's also exactly backwards in a market where prices are currently falling against inflation. The fear that makes you rush is the fear that makes you overpay. Let's put real numbers on the table. 3 people, same starting point, 5 years later. Scott, who bought the most house and believed the most, is furthest behind, buried in interest and mortgage insurance, with almost no equity to show for nearly $200,000 in payments. Aaron, who did everything right, looks better, but watch what happens if he sells at year 5. After 5 years of payments, his equity from principal is about $20,000. His home rose maybe 1% a year to roughly $420,000. But selling costs around 6%, about $25,000, plus the closing costs he paid to buy in the first place. When the dust settles, Aaron walks away with about $95,000 against the $92,000 he originally put in. 5 years of building equity netted him around $3,600. That's it. Now the third person, the one everyone felt sorry for. She kept renting at $2,000 a month, and she did the one thing almost no renter actually does. She invested the difference. She put the $92,000 she would have spent on a down payment and closing costs into the market, and she invested the roughly $800 a month she saved by renting instead of owning. At 7%, 5 years later, she's sitting on about $190,000. Nearly double Aaron. and she can sell any share of it in a day. Here's the honest part, and it matters. The renter only wins because she invested every dollar that buying would have cost, which is the one thing renters almost never do. And because we're in a low appreciation window, stretch the timeline to 10 or 15 years, or put this in a market where homes appreciate faster and buying catches up, then pulls ahead. The point isn't that renting always wins, it's that buying doesn't automatically win. And the difference is decided by numbers nobody runs. So here's how you actually make this decision instead of inheriting it. 4 checks. Run them before you ever talk to an agent. First, the price to rent ratio. Take the price of a home and divide it by the annual rent for a comparable place. Under 15, buying is generally favored. 16 to 20, it leans toward renting. 21 or higher, renting wins clearly. It's one division, and it instantly tells you which side of the bet your specific market is on. Second, the adjusted 5% rule. Multiply the home's price by about 6% at today's rates, then divide by 12. That's your true monthly cost of owning before any equity. If you can rent a comparable place for less than that, renting is mathematically cheaper, and the gap is yours to invest. Third, the break-even horizon. Because of all those transaction costs, roughly 3% to buy and 6% to sell, buying usually doesn't beat renting until you've stayed somewhere between 4 and 6 years longer in expensive markets. So ask yourself honestly, am I staying that long? If you're not sure, that uncertainty has a price, and it's steep. Fourth, and most important, if you rent, actually invest the difference. The renter only beats the buyer because she put the savings to work. If that money just funds a nicer lifestyle, renting loses. The math only works if you treat the gap like the mortgage payment you didn't make. Now, you can run all 4 of these checks by hand, and honestly, you should. But doing it for your exact situation takes some math, so I built a calculator that does it for you. You plug in the home price, your down payment, your rate, the rent for a comparable place, and how long you plan to stay. And it shows you the one number that decides everything. The exact year buying finally beats renting. For you. It's in the Wealth Logic membership, along with the rest of our decision tools. Links in the description, and to be clear, sometimes the answer is buy. If you're staying a long time, your life is stable. You're in a market with a low price to rent ratio, and you genuinely want the home, then buy it and feel good about it. Just buy it knowing what it is. Because that's the real lesson here. Aaron measured equity when he should have measured total wealth. Scott measured pride when he should have measured math. Neither of them ever asked the only question that mattered. Is this house actually a wealth machine? Or is it a lifestyle purchase I'm telling myself is a wealth machine? A home can be a wonderful thing to own. Stability, control, a place that's yours. Those are real, and they're worth paying for, but they're a lifestyle, not an investment strategy. And the moment you confuse the two, you stop running the numbers and start believing the story. The decision was never rent versus buy. It was running the math versus believing what you were told. Now you've seen the math. Run it on your own numbers before you sign anything. If this video showed you something nobody told you before you started house hunting, subscribe to Wealth Logic and hit the notification bell. We break down the hidden math behind the financial decisions you face every day. And if you want that calculator, plus the rest of our decision tools, the membership link is in the description. Run your own numbers before you sign anything.